Hello and welcome to another video. I'm Adi from Pixel Profits, and today we're going to talk about market structure. This is going to be video one in a series of videos I'm going to do on market structure. So we're going to start off with some basics, but this is going to be the building blocks for everything else in the series of videos that I'm planning to make. So take your time to understand these concepts. They're not too complicated to get started with, but we will be going into far more detailed and advanced concepts using the things in this video as a foundation for all of that. So take it slowly, pause the video, take notes, screenshots, whatever you need to do. Okay, so market structure is probably the most important concept to understand. It's one of the first things that you want to consider when you open a chart, and no matter how you trade, it can help you to stay on the right side of the market and therefore give you more winning trades. You could in theory trade with just market structure, but we're going to add on a lot more to this going forward to make it even more powerful. But for now, it's key to understand, and as I said, it can only be a help to your trading, no matter how you look at the market or what strategy you use, even if you have one that you're using at the moment. Okay, so let's get started. So on the screen here, we can see three different market profiles, and this is how the market moves. It either moves in an uptrend, a downtrend, or a range or consolidation or accumulation, which is just basically a sideways move. So we're going to ignore the range for now, and we're going to cover that in later videos. But for now, we're just going to look at uptrend and downtrend. So in an uptrend, we have a series of higher highs and higher lows. And in a downtrend, we have a series of lower highs and lower lows. And we can also call an uptrend a bullish trend and a downtrend a bearish trend. Now these highs and lows are formed through a series of expansions and pullbacks, expansions and pullbacks, expansions and pullbacks, and so on. It's exactly the same for the downtrend. So to define which of these profiles we're in, we can sometimes just look at the chart and we can see it really clearly, like on these examples here. But of course, it's not always as perfect as this. It's not always this obvious. So if we use a structured and systematic criteria for identifying structure, then we can be confident, from the perspective of probabilities at least, that we are trading with the direction of the market. So let's look at how we do that. So in any trend, we can say that a high or a low has a task. The task of a high is to put in a new low. Now, by a new low, I mean a lower low, not an internal low like this. So a high should put in a new low. That's what it should be struggling to do. And a low then should be doing what? Well, you guessed it, putting in a new high. And by new high, again, I don't mean a high here. I mean a new high, a higher high. So in an uptrend, the low is trying to put in a new, the high is trying to put in a new low, and a low is trying to put in a new high. Now what we can see quite clearly then is that this high has failed to put in a new low, because here's the previous low, right? So we've failed to put in a new low. Whereas this low has succeeded in putting in a new high. So what we can say then is that the high has failed in its job, whereas the low has succeeded. Now that brings us on to what we call the concept of strong and weak structure. So if we have a high that has failed to do its job and put in a new low, that becomes weak. It shows weakness. It wasn't able to fulfill its task. It collapsed, let's say, before it got there. So therefore it becomes weak. And weak structure, we expect, is going to be run through. So when we come down and we get this pullback and then we start to shift upwards, we could be considering here, especially if we know we're in an uptrend, that this is going to be a weak structure that's going to get run through them. And we could apply the same logic then. Sorry, let me just do that again. We could apply the same logic here and the same logic here. Now, there's no guarantee that's going to happen, of course, but because the trend could change, but that's one of our expectations when price is moving upwards. So what happens then is when a structure gets broken, we have something called a break of structure. Now, what that means is that when price pulled back and we find a new lowest point, when that lowest low puts in a new high, and all it needs to do is break above the previous high with a body closure or a candle closure, not just a wick, but a full body closure. Then, once the body is closed above this old high, we call that a break of structure or a boss. So then we can apply exactly the same logic here. When we get a new high, we come down, we make a new low. When the lowest low within this range, between where we pulled back from the high and between where we break the high, we're looking for the lowest point. Okay, and that's here. Now, of course, it may look like this on a real, let's say, 4-hour chart or 15-minute chart, whatever, doesn't matter. It's going to look something more like that. But the important part is that when the high has been put in and a new low gets put in, the lowest low, it's this low that is responsible, we say, for breaking through the old high that was put in. So this low then becomes strong because it succeeded in doing its job of breaking the structure. So then what we can do is say that this, let's start on this one, this example. Once we've broken the structure with the body close, this low, only once we've broken the structure, becomes a strong low. And then what we expect from this then is that when price comes back down, it won't run through this strong structure. It won't go through like this. So when we continue and price goes up and we come back down in a pullback, we're expecting this strong low to hold, and we're expecting that this is probably going to be weak and get run through. So we come back up, we do close above it, above this previous high, causing a break of structure. And that means that as soon as we close above it, this low now becomes our strong low. And then we do exactly the same thing here. When we come back down and we break through it, we now have a strong low there. So we move our strong low up, move our strong low up, and this structure should then be protected and shouldn't get run through. It should just have a pullback and an expansion higher. And it continues until it doesn't anymore. So it's exactly the same thing on the downtrend. We'll do it quickly. We come from an old high. We make a new low. We have a pullback, but we fail to make a new high. So we're not in an uptrend. We're now in a downtrend. And what we're expecting then is potentially, because we failed, this low has failed to make a new high, we expect this becomes weak and it's likely to get run through. When it does get run through, we have a break of structure. And it's this high that caused the break of structure of that low. So then we have, instead of a strong low, we have a strong high. Because this high succeeded in doing its job of breaking this low. So we just continue with the same thing. We pull back, we break structure, we break this low, we take our break of structure and we put it here, because this high caused the break of structure that broke the low, and therefore our strong high now becomes this one because it succeeded in its job. This low failed in its job of making a new high, right? So we move our strong high down, and then we get a new break of structure here. Price comes up, breaks through. So where do we move our strong high to? This high. And it continues. So we can see then that expansion moves lead to pullbacks, and breaks of structure are also going to lead to pullbacks. Because once we break through the structure, we expect after a break of structure that pullback's going to happen. So in this way, when we come up and we break structure and we expect a pullback to happen, we can see that whichever trend we're in, if we track very simply our lows and our highs in this way, from the lowest low that breaks structure or the highest high that breaks structure, then we can keep track of where we are in the market, what we're trading, whether it's trading expansion or pullback, and what to expect potentially next. So what are these trends showing us? I mean, what they're basically showing us, right, is that in an uptrend, we've got an imbalance between the amount of suppliers there are selling whatever it is that we're buying or people want to buy, and there's many, many more buyers. So as the sellers sell their positions and there's less and less sellers available, price gets pushed higher, and exactly the opposite in a downtrend. Now, something else we can see is that when we're moving up in price, that in an uptrend, the long positions or the bullish moves here are longer than the short positions would be. As in, if we were trading within here and buying or trying to execute a trade, we'd have a lot more of an up move to do that within than we would when we're going short, because it's a much smaller move going short here than it is going long. Okay, those are shorter moves going down, longer moves going up, shorter move going down, longer moves going up. Now, again, it's not always guaranteed, but it is often that way. So we can trade both directions of this, knowing what phase we're in, but we just need to be careful, because if we buy, let's say, down here, and we're going long, then we've got a good amount for our trade to play out, and we're quite likely buying a good price down here. If we start trying to buy or enter more long positions up here, does that seem like a smart idea when we know that after a break of structure, a pullback is likely to occur, because we're going to get stopped out, right? So you can trade either direction. You just need to know when you're going to do it based on where you are in the phases of the market. So that sort of brings us on to a quick overview of the concept of external, internal, and microstructure. What is that? We're going to come back to all of that much later. But basically what it means is that, let's imagine that we're on a 4-hour chart now, or a daily chart, whatever, it doesn't matter, a bigger time frame. Okay? We're going to get our external structure, our real trend, where we're actually heading in the longer term from the bigger time frames. So in this case, let's say it's the 4-hour. So our external structure is these big swing points. But what we talked about a minute ago is that we have these smaller moves within the big moves. And that's what we would call our internal structure. Now, you can, of course, get trades within this, especially if you drop to these smaller time frames, and we're going to come back to that later. But these smaller moves within the bigger overall trend are what we call internal structure, internal moves. Now, microstructure is going to be, I can't even draw it on here because it's going to be very difficult to do on this small diagram. But basically, within, say, the 4-hour moves here, the internal moves, you're going to have tiny little moves on other time frames all over the place. I mean, that's terrible, but you get the idea. And microstructure is basically the way we refer to those. But also, if you think about, let's say, 2 candles next to each other, 2 4-hour candles, and both of them have wicks going down. Well, a 4-hour candle on a 4-hour candle is an entire range of price on a 15-minute chart. Okay, it's all kinds of moves and uptrends and downtrends and stuff. So that sort of thing, and we'll come back to it later, but that type of small micro moves, 2 wicks overlapping, for example, 2 wicks overlapping means price came down, went back up, and went back down again on another time frame. But you'll just see 2 straight wicks going down, or of 2 candles next to each other, or like this maybe, 2 overlapping wicks. But what is that? That's a entire move on another time frame, right? So that's what we refer to, or I refer to, as microstructure. You've got external structure as the overall trend. Internal structure is the moves within the trend on the same time frame, but especially on smaller time frames. And then you have the microstructure, which is tiny, small things that we're going to come back to later, which can act as points of interest. And what that means is basically that if you sit on a 4-hour chart and you look at microstructure on a 4-hour chart, you can tell without even switching to the 15-minute chart what's happened on that chart. So to wrap up the video, we're just going to quickly go through the expectations just for the uptrend, because it's the same for the downtrend, just the opposite. What do we expect in an uptrend? We expect higher highs and higher lows created through a series of expansions and pullbacks, expansions and pullbacks. Highs are failing in their tasks to put in new lows, whereas lows are succeeding in their task of putting in new highs. That makes failure weakness, and it makes success strength. Weak structure or failed structure is likely to get run through. Strong structure is likely to hold. When a low, the lowest low, breaks through a high, this indicates strength and it becomes protected or strong. After a break of structure, even though there's strength in the market, we still expect some kind of pullback. So we might want to think about stopping looking for long positions after a break of structure in an uptrend. After a pullback, we expect an expansion. So then we stop looking for short positions. If we track the strong and the weak structure, then we can understand the zone that we're currently trading in and which direction we want to be looking for positions. And we can also anticipate where the market might go next, multiple steps in the future, potentially. Be careful with that. Don't predict, just react, okay? So we can trade in both directions, from strong structure towards weak structure, and then back towards strong structure, and then from strong back towards weak, and so on. And we have a good probability of success if we follow this system. This process just repeats over and over until it fails and the trend potentially changes. So I think that's covered everything for this video. In the next video, we're going to go over reversal patterns and how these trends change from one to the other. And once you have those two things, I think you're in a pretty good position to even get started on a chart of marking this type of stuff out and trying to track where you are on your chart and what the trend is and where you're going to trade within that trend. So I would say, if you need to, watch this video again. If you feel comfortable with these concepts, and we're going to go over them again in the second video probably anyway, then move to the second video, have a look at that, and then after that, we'll go on to a real chart example of marking all this out in a proper market, so you can see how it plays out in reality. So if you found this video useful, like the video, comment, ask any questions, I'll try and answer. And don't forget to subscribe and hit that notification bell. Hope to see you in the next video, guys. Take care and thanks for watching.